From a defabricated solar-powered garden shed in Rockland County, New York, USA, this is Stand Up with Pete Dominic. On today's episode, the top 10 signs you should probably shower. And now, the podcast host who has no use for regular showers because he is oh so naturally scent-free, Pete Dominic!
That's right. A lot of people wonder what I smell like, and I'll tell you, it's neutral. Nothing. I smell like nothing, except for when I wear cologne now to impress my wife. Folks, thank you very much for tuning in to today's episode of Stand Up. Great to be back. I took a couple days off, much needed days off. May I highly recommend not only to take time off, but to put your screens away as much as possible. I was out there in the garden. I was out there exercising. I was reading books and writing and meditating and taking walks, and it felt real good. Feeling energized and renewed and rejuvenated. Thank you so much for your support, all your kind emails. I said I was taking a couple days off and that I had made the difficult decision not to run for town council after making the difficult decision to run for town council. And people always write and say the nicest things. You guys are the greatest group. I hope to see you on Thursday night at our hangout if you're a subscriber. If you're not, what are you waiting for? Go to standupwithpete.com. It's the beginning of a new month here. And happy birthday to Mom. She just celebrated her birthday. Thank you to everybody who wished my mom a happy birthday. I'm going to try to get her on this week. But today, I've got the great Barry Ritholtz. Today, we are going to learn about what happened with this bank out in California, Silicon Valley Bank, and had a great conversation with him. Before that, talk a little bit about the Alaskan oil project that the Biden administration just greenlit. A total broken promise. Real bad news as President Biden approved the controversial Willow project in Alaska. Oh, and thank you to everybody who watched CNN Friday night. That was cool that they asked me to come into New York. I was supposed to be taking time off, and I went, and I did do that. So I did do that. But that was fun to be on set with Alison Camerata and Molly Jong Fast and LZ Granderson. And I forget who they had, this conservative black guy, and they never even told me he was going to be there. I got his name when I was on set. I was like, hi, I'm Pete. It's like, I'm Joel. And he didn't have a lot to, I feel, add to the conversation. I was thinking about having him on, but I'm like, nah, I don't think so. I wasn't really that impressed. I don't know where they find some of these folks, but thanks to all of you who did tune in and watch that. I'll just briefly share my comments about Ron DeSantis. They showed a clip of Ron DeSantis in Iowa campaigning and talking about the wokeocracy and wokeness and all of that. Here's just like 5 seconds of this nauseating, inducing man.
Our state is where woke goes to die.
And my panel is back with me. Yes, Pete?
Oh, it's just, I'm just nauseous watching him. He is so filled with hatred, and he is so spreading that hatred around this country. And I just know so many people right now that are so afraid for their kids who identify as trans, for themselves who identify as trans. And not only that, like LGBT people, and of course people of color. It is just so dangerous what he is doing.
People in Florida, as he has pointed out, seem to like it. People are flocking to Florida, and his ratings
we
are
have
high.
A lot of people in this country who are filled with hate, filled with the fear that drives that. And the idea, the word woke, yeah. I hear that word and I hear something completely different.
Right. And we have talked about that it means something different to everybody, but I don't know that it's hatred. I mean, some people really like that he is pushing back on these cultural changes.
To talk about kids, to say let kids be kids, and then you're not letting them actually talk about who they are, be who they are. It is despicable, and he's using children, and it's horrible. And coming from the Republicans, who are constantly talking about protecting kids, they are putting kids in such danger around this country.
Yeah.
And by the way, I wasn't even ready for that story. They didn't even tell me we were going to be talking about DeSantis, so that was kind of off the cuff, and I regretted that because I would have had something a little smarter or snappier to add to the list of what Ron DeSantis has done and the threat and dangers that he poses. I appreciated her trying to push back, but yeah, I wasn't buying it. So my friend Alison Camerata, thank you very much to those at CNN who brought me in. Always good to be on. And now I want to just get to these two top stories from today. First, I want to share with you this story about the Biden administration green lighting the Willow project, which is a major oil and gas development in Alaska. And I thought this was a pretty good, just about 3-minute recap. But first, let me just play for you candidate Biden. This is Joe Biden on the campaign trail in New Hampshire back in 2019.
You're not the only one running who's been up in the Arctic Circle. Remember the great oil spill that occurred? And I watched when I went up there, and I went up in a helicopter up on the North Slope and saw what was going on and saw what was happening as the glaciers began to melt and how the caribou and everyone, there's a lot going on up there. And it's a real gigantic problem. And by the way, no more drilling on federal lands, period. But the Arctic Circle is a disaster to do that.
All right. Well, maybe not so much. Maybe not so much with all those periods. That's candidate Biden. Everybody's calling this a broken promise. Here now is CNN's Jake Tapper with correspondent Renee Marsh giving us the rest of the context.
Enraging environmentalists, the Biden administration officially approved a massive oil drilling project in the National Petroleum Reserve on Alaska's North Slope. It breaks a Biden campaign promise to end new oil and gas drilling on public lands, but it does please Alaska's bipartisan congressional delegation. The White House is also making the move over the objections of progressive Democrats and environmental groups who say that the venture will hurt the president's ambitious climate goals as well as the planet. CNN's Renee Marsh joins us now live with details. Renee, what is the White House saying about this change in policy and, frankly, broken promise?
Yeah, well, Jake, the administration is saying, look, our hands were tied due to the courts, due to legal restraints, pointing to the fact that ConocoPhillips, the oil company that's leading this project, has held these oil drilling leases for decades now, and they didn't feel that they had the legal standing to take those rights away. However, CNN spoke with environmental lawyers who would beg to differ, but some more detail on what exactly was approved today. This is a major oil project, again, led by ConocoPhillips. It is in the northwest region of Alaska, very remote land. It's on federal land. It holds up to 600 million 600 million barrels of oil. But it would take several years for this oil to make it to market because the infrastructure has not yet been put in place. By the administration's own estimates, there would be a release of the same amount of planet warming greenhouse gases as roughly 2 million gas-powered vehicles added to the road, just to give you a sense of what the environmental impact would be. And this issue has really divided Alaska natives. There are two sides here, some that say that this is a victory because it would bring revenue into the state. The other side saying that this is an environmental disaster in the making, Jake.
And Renee, the White House is trying to temper some of the backlash to this approval with new protections for some of the land and water in Alaska. Tell us about that.
Right. So on the same day that we heard about this approval of the Willow project, they also announced that they were going to be making the U.S. Arctic off limits for future oil and gas leasing. That would mean some 16 million acres that would be off limits for the future. They're saying that they're building this sort of firewall to prevent future oil and gas drilling in this region. But when you talk to the climate activists, they all are not satisfied with this because they are still looking at the approval that happened today, which they say will have a dramatic impact on what we're trying to do here, which is curb greenhouse gases.
All right. And now here is one of those leading activists. She was on Democracy Now! With Amy Goodman. Her name is Siknik Maupin. She's the executive director of the Selanuat, which is a tribe up there in Alaska. And I don't know that I pronounced any of that right, but I gave it a shot. And I thought this was really important. So this is why I want to play it for you now.
Describe this project. What is the Willow Project and what you understand President Biden's announcing today?
Well, this is the biggest oil and gas leasing project that's on public lands right now. It is a massive project that would be happening in the North Slope. Closest community would be Nilsfit. And this would completely encircle the community in oil and gas, which already has Prudhoe Bay, Alpine. And this is just the start of the project because this could green light for further exploration, further development. And this project would emit so much carbon, it would actually double the amount that Biden had promised that he would reduce. And so all of his plans to reduce the CO2 being released would be nullified by this project and then putting back double what he said he was going to reduce.
Well, there you go. Well, on Monday, the Biden administration granted ConocoPhillips approval for an immense new drilling project, the Willow Oil Project. The reactions have come hard and fast. When the decision began to leak out late last week, former Vice President Al Gore called it, quote, recklessly irresponsible and, quote, a recipe for climate chaos. Senator Jeff Merkley, who's joined me right here on the podcast, Democrat of Oregon, decried it as complete betrayal of Biden's promise. And New Yorker Magazine, Elizabeth Kolbert, who writes about these things, says, both assessments are hard to argue with. The decision to approve the Willow Project is, to use the president's words, a big disaster. This is not just because of the impact that the project will have, though. Certainly that is bad enough. It's also because of what the decision signals. So why did the administration approve it, she writes? Politics is an obvious answer. The approval, according to Politico, is part of a strategy to create a Biden moves to the center narrative heading into next year's presidential election. Joe Biden is a realist about what it will take to win re-election in 2024 for him or any other Democrat. Wendy Schiller, professor of political science at Brown, told the New York Times, although the Willow Project won't actually produce any oil for years, it has been touted as a way to bring down gas prices. In an opinion piece published at CNN's website last week, all the members of Alaska's congressional delegation, 2 Republican senators, and a Democratic representative expressed their support for the project. Quote, we need affordable energy today, and we will need it well into the future, the 3 wrote. The Biden administration presumably looked at both sides of the political equation, decided that the benefits of approving the project to itself, at least, outweigh the harms. The same calculation has been made many times before, including by politicians who know how dangerous it is. Recall Barack Obama's all of the above energy strategy. And that's the reason, even as this country takes steps to reduce emissions, it never seems to really get anywhere. A massive oil project that requires chilling the permafrost is, unfortunately, the perfect metaphor for our time. I'll certainly be talking more about that with activists right here on the show. Let me know who you want to hear. And, of course, the other big story I mentioned that I wanted to discuss and learn more about, and that's why Barry Ritholtz is here as my guest, has to do with this bank collapsing out in California. The Federal Reserve announced Monday it has launched a review of supervision and regulation of Silicon Valley Bank following the lender's sudden implosion. Treasury officials see positive signs in the slow deposit outflows from small and mid-sized lenders. No, you shouldn't pull your money out of your bank. And so many more headlines about SVB, as it's being called. Downfall of SVB caused by absolutely idiotic decisions by leadership, according to one high-ranking employee. And that's something similar to what Barry Ritholtz said. Well, here is Treasury Secretary. This is Janet Yellen. She was on CBS Face the Nation on Sunday. Here's what she had to say.
Let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again. But we are concerned about depositors and are focused on trying to meet their needs.
Can you say whether these problems were unique to Silicon Valley Bank, or can you say whether there will be other regional bank failures?
Well, look, let me just say that we want to make sure that the troubles that exist at one bank don't create contagion to others that are sound. And a goal always of supervision and regulation is to make sure that contagion can't occur.
All right. Well, there you go. There's Treasury Secretary Janet Yellen. Now, here's the former head of the FDIC. Her name is Sheila Bair. She was on CNN. Here's what she had to say. I thought this was more good context before we get to Ritholtz.
Right. So, I think the lessons learned are that when interest rates go up, the value of bonds, securities go down. And so that's called interest rate risk in banking. It's a well-known risk. And some of the banks, a question here, didn't do a very good job of managing that risk. Also, that your depositor base, you need to pay attention to who your depositors are. Do they like your bank? Are they going to stick with your bank, or are they going to leave quickly if there's a sign of trouble, or to get a better interest rate? These are two things that came together that really brought Silicon Valley down. They did not manage their interest rate risk. We're having some losses on sales of securities that had lost value, and then their depositors got nervous, and it was a very small group venture capitalists and the portfolio companies that they fund, and word spread fast, and there you go. So this seems to be an unusual situation. I know there are concerns now in other parts of the banking system. I don't right now see a systemic issue. I think if you're an insured depositor, you should not worry at all. The FDIC has a perfect record of protecting insured depositors. And even if you're a larger investor, an institutional depositor, with uninsured deposits, know who your bank is. But if you've got a longstanding relationship with them, if they're a traditional bread and butter bank that doesn't take risk and has done good service to you in the past, I don't think you've got anything to worry about there either. So I do think everybody needs to keep their heads. This is, again, appears to be an unusual situation that hopefully will not spread throughout the system.
Well, there you go. Sheila Bair. And finally, I've got the president himself trying to calm concerns and fears. This is President Biden trying to explain what was going to happen. I thought this was important context as well.
Before I leave for California, I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place.
All right. Well, there you go. There's some context before we get to my guest, Barry Ritholtz, who has a new piece about this on his blog just before I talked to him on Monday afternoon. All of the things we do not know about Silicon Valley Bank. He also recently wrote a piece criticizing the Fed, titled "The Fed is Breaking Things, and It Could Get Worse." We get to all of this in just under an hour of conversation. People always love when Ritholtz joins the conversation. You should follow and read his blog at The Big Picture, Ritholtz.com. Of course, on Twitter. You should listen to his podcast, Masters in Business, on the Bloomberg Network. Ladies and gentlemen, the author of the book Bailout Nation, the co-founder, chairman, and chief investment officer of Ritholtz Wealth, my friend Barry Ritholtz, and his dog making noises sometimes. Okay, so I took a few days off of screens, which I highly recommend. Almost didn't look at my computer or phone hardly at all. I was out in the garden. I was outside as much as possible. I was doing stuff with the kids. I get back to the screen, and I immediately start learning about this bank, Silicon Valley Bank, SVB. Never even heard of it. Trying to figure out what the hell's going on. Still trying to figure out what's going on. And people texted me over the weekend, and they said, could you please get Ritholtz? And believe it or not, he was able to join me on Monday morning, where things are continuing to happen in the markets with banks, and he's here to help us understand. Hello. Thank you very much.
Hey, Pete. How are you?
Can I read from your excellent.
Knock yourself out.
Latest blog entry, because you write better than you speak.
Don't we all?
You write about this over the weekend. I watched a parade of cocksure analysts and commentators and speculators on several different cable news channels discussing the fallout from the weekend's activities with great confidence, which I hasten to add is surely unwarranted. For what comes next, we still have very little idea of the complex issues of what actually happened, whether it's crisis management, commission trades, syndicate, or literally book sales. Lots of people are all talking. Their book tends to provide little illumination. And then finally, you say, and I think this is the most important pull, over my 3 decades of surfing crises on Wall Street, the one unifying thread that connects all the major events is just how little we know as they unfold, and how much we learn in the ensuing months and years. The first draft of history is typically emotional, rarely accurate, and often conflicted. Ritholtz, so you're saying is that it's unfolding right now, so we don't know much.
Absolutely. That's basically what always takes place during these events. We don't know what happened. We get these sort of spasmodic, here's what I think. And very often it's based on little pieces of information and not a lot of facts, not a lot of details. You know, I used 4 books in the blog post you're reading from as examples of just these big things where we all believed we understood what was going on. And then subsequently, the books reveal how little we actually knew at the time. So
did you include Bailout Nation, which you wrote?
I thought that would have been a little self-serving.
Oh,
so
I would have included it on my list.
Well, you can, and I guess I'll add a postscript to it. Pete Dominick suggests adding Bailout Nation to the list, but I didn't do that because it's so
I'll tweet it and you can reshare that. There you go.
Okay, there you go. But I'll give you just a couple of examples. So if you want to get specific about a company, the rise and fall of Enron, Bethany McLean's book, The Smartest Guys in the Room, The Amazing Rise and Scandalous Fall of Enron. You learn stuff about that company that you thought you knew, but you really didn't. Or Roger Lowenstein's When Genius Failed, about the collapse of long-term capital management that was just festooned with geniuses and Nobel Prize winners. And if you want to get more recent, Michael Lewis's Big Short about subprime and derivatives and securitization. He explained what happened during that period. Bailout Nation was about, going back centuries, about the rise of the Fed and all these other, the rise of regulation and the Great Depression and all the New Deal legislation, and then undoing that in the 1990s. But if you want like a real big overview, look at Maggie Mahar's Bull, A History of the Boom and Bust, 82 to 2004. She explains all sorts of stuff that the average person just simply has no idea what happened.
I highly recommend anything that Ritholtz recommends. And I will, I was going to say I'll link to these, but he mentions all these in this latest blog post, all the things we do not know about SVP at Ritholtz.com. Go ahead. So we read those books and they all point to the point that you're making, which is we probably didn't know a lot while it was happening, while it was undoing.
Yeah, exactly. But the so-called first draft of history, it's rarely correct. It basically is, here's what we've found. And the same thing is going on with SBF and FTX and all the crypto stuff. The things we think we know, we really don't know.
Right. Appreciate that. I appreciate that response because your industry, our industry of commentators, wants to give some kind of content for people to chew on, and certainly answers in times of fear. Obviously, we learned that through COVID. We learned that through these financial crises. A lot of people make a lot of money, but let's be, clear. There are some things we can point to, can't we? Josh Brown, your colleague, I thought had a pretty smart piece over at his blog, The Reformed Broker, talking about what happened to a certain extent at SVB. And my understanding is that they had a bunch of money and they invested it in something that the Fed rates made worth less, and so they lost a lot, and people started pulling their money out. How about that? Simplification.
That is the broad overview, and I would say we know all of those things. So that's one of the few things we actually
that was a
know.
Shitty broad overview. Do you want to punch that up a little bit? I would just take
sure. So Silicon Valley Bank. I had the CEO on Masters in Business in 2021. and it was intriguing. They're a kind of unique bank, in part because they're located right in the middle of Silicon Valley, where the innovation engine of American technology for the past, 50, 60, 70 years. They've been around a long time. They've always been very conservative. So Silicon Valley Bank, by nature of where it's located, the nexus of where it is, the relationship it has with all of these tech startups, ironically, they are very conservative. They didn't blow up because they were in a lot of speculative junk. They were investing in startups. They set up a separate entity apart from the FDIC regulated bank that has relationships and perhaps has some toe in the water with some startup stock and this and that. But the core business of opening up bank accounts and servicing this community was run fairly conservatively. And the great irony here is it wasn't securitized subprime mortgages or junk derivatives. The great irony here is that they bought long-term treasuries.
So just what I'm hearing is that they weren't invested. They weren't taking their depositors' money and investing them in risky bets like, as you just mentioned. They were investing them in what were considered the most conservative investment, thus not growing at a rapid rate, but treasury bonds. Right.
Now here's the twist. And one of the questions I ask, all the things we don't know here are 10 questions, which actually are more like 30 or 40 questions.
And they're all in this blog entry, all these questions, which we want to try to get to some of them. Yeah.
Bond investing rule number one is, hey, you don't want to be long duration, even safe treasuries in a rate hiking cycle, because the longer term bonds are more sensitive to interest rate changes. And so what we did in the office in Ritholtz Wealth Management in the beginning of 2022 was, when it was apparent that the Fed was going to start this rate hiking cycle, you shorten your duration. You go from 7 to 10 years down to, 3 to 5 years or 2 to 3 years. Why? Because you're getting the same interest for holding money for 2 or 3 years. Why do you want to lock it up? And between now and maturity, right? So those bonds are money good. That's cash in the bank. If you buy a bond at par, at $100 as par, it'll trade up and down around par depending on where rates go up. So hypothetically, rates go up. I'm going to use round numbers. Rates are at 0%. The 10-year is yielding 2%, right? Hey, because we don't think rates are going to be at zero forever. So you're getting some yield. When the rates go up to 5% and the Treasury Department issues new bonds, as they do every year, so that it's borrowing money to cover the shortfall, to cover the deficit. Well, if the yield is 5% and I'm looking at, hey, do I want to buy these new bonds that are yielding 5% from Uncle Sam? Or do I want to buy these old bonds that are yielding 2%? Well, that's pretty easy to figure out. The credit risk is the same. It's Uncle Sam. And so you get the 5. So in order for nobody's going to buy those 2% yielding bonds until they begin to approach 5%. And the way that happens is you pay 90 cents on the dollar for the bonds yielding 2% that came out in 2018. And so that'll get the yield up as you pay less. Your total return goes up because you're getting some capital gains and some yield. The math in this is really simple. There's spreadsheets all over the internet. I don't want to overcomplicate this.
Too late, but I think I might have followed it.
Yeah, no, it's pretty straightforward. Why buy 2% bonds, 10-year bonds, when I could buy 5% 10-year bonds from the same issuer, the U.S. government? And so in order for those 2% bonds to actually trade, they have to have the equivalent yield equal to whatever the new ones are. And that means they go, hey, these go on sale. It's like going into the supermarket. Milk that's good for 3 weeks is here. Hey, this milk goes bad tomorrow. You're going to have to sell it at a discount. Same sort of concept. And so the discount makes the equivalent yield look very equal. So what ended up happening is Silicon Valley Bank had billions and billions of dollars, hundreds of billions of dollars in treasuries and other things, mortgage-backed, which, they're money good. There's no risk for the Fed going out and saying, we're going to buy all this at par. So they're just essentially taking it off their books And that's how the Fed over the weekend was able to say all the depositors will have full access to their money on Monday. The stockholders get wiped out once the FDIC takes over a bank. So this is a combination of the FDIC and the Fed resolving this. Now, how much did, here are some of the questions. How much did the unprecedented rapid increase in Fed rates break this bank? Right. I mean, that was Friday's blog post. The Fed is breaking things. And people push back on that a little bit. And it's always funny when, normally it takes years or months to be proven right. When the next 2 days later, it's like, oh, I guess the Fed did.
By the way, in that one, you also had a really important caveat as the introduction to that entry, which is, I can't recall it, but you're not piling on the Fed. You're not one of these.
Right. Listen, to me, one of the things that I've always despised, I particularly loathe managers who lay all the woes of the world at the feet of the Federal Reserve.
Right.
Hey, for more than a century, America's central bank has been a key part of the investing environment. And if you're an active manager, well, guess what? It's your job to incorporate their policy into their strategy. Whenever I see someone blindly blaming the Fed, at first thought is it's lazy. And second, when I hear the words financial repression, in my brain, that just translates into, this manager's been underperforming for a while. And that correlation is uncanny. That's a pretty fair, it really is a pretty fair statement.
But you then say that the Federal Reserve has become the bear in the china shop.
Yeah, which is an obvious pun on the bull in the china shop because, the Fed is. So here's my complaint about the Fed, which is simply this. And listen, it's an impossible job. And I'm saying all these things with the benefit of hindsight, although I was complaining about some of these in real time. And listen, my track record, I don't bat 1,000. I get a lot of stuff wrong also. I like to admit it and own up to it, but which is sort of rarity in my field. So here's what happened. The Fed stayed at zero or very, very low interest rates for a long time. I complained about this following the great financial crisis and said, instead of us trying to respond to the economy, the Fed is keeping rates really low because all these banks have a bunch of junk mortgages on their books. And as long as rates stay low, those mortgages will reach maturity and they will run off is the technical term. They will eventually reach maturity and be done and it'll come off the books. And so we had a very subpar economic recovery following the financial crisis because of Fed action. Worked out to be great for people who own assets. If you own stocks, if you own bonds, if you own real property, if you own businesses, if you're in the top 10%, hey, the Fed is your best friend.
Right.
And now we see the Fed raising rates because wages are going up and house prices are going up. And none of these things are caused by low interest rates. We had low interest rates for a decade. So my complaint about the Fed is first, I won't relitigate the post-financial crisis, but I believe I was right and Ben Bernanke was wrong. He has a Nobel Prize. I don't. So, take what I say with a grain of salt. Second, not that social proof is the end all and be all, because we've seen lots of Nobel laureates not say such great things over time. Second, the Fed was, regardless of the post-financial crisis period, the period following the pandemic, lots and lots of signs that at the very least, nobody can really argue with this statement. The Fed remained on emergency footing at 0% interest rate and continuing to do quantitative easing long after the emergency ended. Certainly long after the first part of the emergency ended. And then second, once it was fairly clear that the pandemic wasn't going to cause a giant problem, I mean, aside from, 1.5 million Americans dead and 20 million with long COVID, I'm not talking about that. From an economic and banking perspective, it does not appear that by the end of 2020, when the markets had recovered, they bounced from their lows up 68% by July or August. I believe it was August. They were back to the levels they were pre-pandemic crash, that 34% crash. The Fed very much ignored that. Or I should say the Fed did not act on that. And then the next year, the markets ran up another 28%. And the Fed really, I know they weren't happy about it, but they didn't act on it. And keep in mind, the Fed has a inflation target of 2%, which in 2021, the market blew through in March.
Now they have that inflation target.
No, that's been their inflation target for years. And during the 2010s, they couldn't get inflation up to 2%, despite zero and QE and blah, blah, blah. Right. They could not. So there's that. And so once the Fed funds rate went through 2%, and here's full benefit of hindsight, March 2021, they should have started a modest rate raising cycle, get off zero, go 25 bips, every meeting go 25 bips. By the way, the issue here that's kind of fascinating, rates are still
0.25,
below.
Is that what 25 bits? 0.25?
0.25, 25 basis points. Bips. Sorry for the jargon. My head is full of jargon. Rates historically, what are we, like 4.5, 4.75% is their range today, I think is where we are. Those are historically low rates. Those are lower than the rates that contributed, didn't cause by themselves, but contributed to the financial crisis in the 2000s. The problem, in my opinion, has been the rapidity, the pace of the rate increases. And it looks to me, by not getting off emergency footing for years, by waiting from March 2021 to March 2022, right? Rates went through their target inflation went through their target in March 2021. They waited a full year to start raising rates. I think they panicked. They tightened way too quickly. Even though rates are at a fairly modest level, I suspect it was the pace of rate increases that is the problem here, and it's causing things to break. Well, look no further than Silicon Valley Bank as the example. And so now markets are up now, Monday morning at 11:48. The Dow is up 200. The S&P 500 is up about 28 points, about 0.75%. The NASDAQ is up 1.4%. And I think that's because people are thinking, we don't know what the Fed's going to do, but 50 basis points is off the table for the next meeting, and maybe even 25. Maybe the Fed is going to have to say, hey, because as much as we're concerned about inflation, and my opinion, inflation peaked last June. I think they're way behind the curve on that, but hold that aside. We're going to do nothing because there's so much instability and raising rates are going to be problematic. And that's bullish for stocks with the Dow up, 200 points.
Well, you're talking about the markets today, and my question is, and what I read just before we came on, that there was a lot of concern, or the stocks
regional banks are getting shellacked.
Like, what about banks today? And then you can talk about other sectors as well. I think Josh Brown was talking about like real estate development, commercial real estate, but like what is happening to banks today that are otherwise likely invested the way SVB was in these treasury bonds?
So, well, first of all, a lot of these banks were not as concentrated in the 10-year. They had shorter duration. That's number one. Number two, the lesson from the financial crisis, the lesson from 08, 09, is that the Fed will move heaven and earth to keep the financial system liquid, operating, and banks are the lifeblood. I say this for everything, but banks are really the lifeblood of the economy. If you want to, first of all, think about everything that goes through a bank. Your personal deposits, your household accounts, your business accounts, anything that's paid for on a credit card, anything that's paid for on credit, a mortgage, a car loan, just without a functional financial system, there is no economy. You're trading bearskins for sharpened sticks. There's no economy without finance, which is why we have, as a society, perhaps allowed bankers to dictate a lot of terms. And, one of the questions I ask is, hey, Greg, I'm trying to remember his name. I'm drawing a blank on his name. The CEO of Silicon Valley Bank in 2018 petitioned the Trump administration to roll back some of the Dodd-Frank rules. None of this is opinion. This is all fact, which they did. What Becker is not known is what was the impact of those rollbacks, and did they have a effect on the actual collapse of Silicon Valley Bank?
Greg Becker. Yeah, that's the question.
Greg Becker, right.
That's the question a lot of folks are asking, or if the blame is being put squarely on deregulation that Republicans...
Look, you know my view in Bailout Nation that we had a 20, 30-year run-up to the financial crisis that was characterized by the era of deregulation, the repeal of Glass-Steagall, just on and on and on. The Commodities Futures Modernization Act, which eliminated derivatives from requiring any sort of financial reserve like typical insurance products. So whenever I see deregulation, my spidey sense starts to tingle. Now, that said, one of the things that was a problem during the financial crisis was junk paper didn't have to be marked to the actual market. I mean, like speculative, this may not be here next year paper. So we used to call that mark to make believe. It's like, oh no, this was worth $100 last quarter. We'll put it on our books at $100, even though it's trading in the market at 50, 40, 30. So the question I raised is, hey, since Treasury bonds are money good and any downturn is just temporary, you will get $100 per bonds back at maturity, even if it trades below that today. Maybe we shouldn't require treasuries and just treasuries not to be marked to market. They're par. We're holding them to par. I don't care what happens if they go up and down. They're at par. So maybe that's one place where the regulations need to be adjusted. I honestly can't even tell you what the rules around that are, right. But it appears that Silicon Valley Bank, in order to make up for the paper loss on their treasuries, which is no loss at all if you hold it to maturity, did a raise, and that's what sparked the run. A bunch of venture capitalists advised their founders fund, probably most notably managed by Peter Thiel, advised their investment companies, hey, move your money out of Silicon Valley Bank.
Wow.
It was, and what did they know? Did they know non-public information, which is problematic? I'm not saying it's illegal. I'm saying it's problematic. Second, did they have any conflicting issues or investments, or, did we just collapse a bank because somebody made a bet against them? I don't know. Again, I'm not suggesting these things. These are the things we don't know. And three, God, it's like, you have FDIC insurance. That I guess people were concerned that it wasn't money good, but it turned out that the FDIC and the Fed came in and said, all your deposits are fine. You don't have to worry about it. This is covered by FDIC insurance. This isn't a taxpayer bailout. This is why we have insurance. By the way, this is a Roosevelt era rule change that created the FDIC to prevent exactly these sorts of bank runs.
Right. Yep. Well, I think that the big concern that folks who don't understand finance or pay attention to headlines around banks is contagion. Am I pronouncing that right? Meaning, if I was hired by a small firm in California to come speak at their annual gathering or do comedy at their annual gathering, either one, I'm available for both folks, then I'll make a hybrid speech. I'll make it funny. Anyway, I'm going to lose that gig because they had all their money in SVB. They don't have any money to pay me. The concern for people that don't pay attention to this stuff is that they are going to be affected. Their businesses, their gigs, their work, their clients. What do you say to that?
Well, now we know that everybody who has their money in the banks, they're going to, they can access the cash today. It's not like it disappeared. So that's first and foremost, the crisis at Silicon Valley Bank and Signature Bank is gone. What we don't know is what's going to happen at other banks, what other regionals are at risk. And so that's a concern. I spoke to a friend in New York, somebody I know from one of the car clubs, who owns a ton of real estate in New York City, tens of thousands of apartments. He has every building has its own separate account with Signature Bank. And I'm sure he spent the entire weekend crapping himself. Then the FDIC comes out and says, the accounts are good, the money is good. So he got to exhale. Oh, your whole business isn't going away. Isn't that nice? Because you happen to choose a local bank that somehow screwed up somewhere.
Well, thank God for all the car club people.
But it's always interesting because you get to hear stuff that you don't read
about. Of course. No, I'm glad that you have access to these people.
By the way,
I don't.
You know me long enough.
No, I know that you're a luxury watch guy. You're not a car guy.
But, most of my watches are shit I bought 30 years ago for $100. It's not.
You're a luxury steak guy, not a car or a watch guy. Luxury food.
Cheap and cheerful. My favorite Thai restaurant in New York City closed. I'm totally bummed.
I'm sorry.
That's like a spectacular $30 meal in New York. Super. It's not about It's not about the money. It's always about the people you socialize and the memories you create. And because I can move, Mike Batnick in my office once said to me, so I interview Ray Dalio, who runs Bridgewater, the biggest hedge fund in the world. He actually just retired. And Mike Batnick in my office says to me, how could you ask him some of those questions? I'm like, it's all from the book. It's fair game.
Mm-hmm.
He goes, that's your superpower. I'm like, what are you talking about? You talk to Uber drivers and billionaires the exact same way.
Yeah, I agree with that. I thought
it was very astute observation, but
that's why we like you.
But here's the thing. When I'm hanging around with a bunch of billionaires, or at least, centimillionaires,
you don't act like an Uber driver.
Right? I'll ask them shit. I'll say to them, hey, this rule change that Governor Hochul proposed about, density in suburban New York, what does this do to your business? And some guys will give me the Fox News answer. And some guys will say, if it's as is, it's problematic, but none of these things pass as is. Historically, they work with the industry and try and come up with something. And so, you get the initial response, and then you get the in-depth response, which is always interesting. My favorite thing is a bunch of guys who were Trump supporters in 2016, much softer in 2020, said, thank God for the FDIC and thank God for Sheila Bair. And I had to point out to them, hey, Sheila Bair retired from the FDIC a decade ago. Number one, the fact that you don't know who the FDIC chair is actually a great positive, because we effectively, if you know that Martin Gruenberg it was sworn in January of this year, that means something has gone bad. So that's number one. Number two, who would expect a bunch of Trumpers were big fans of Roosevelt era banking regulation?
Right.
Good for you. You guys have come around. So now deregulation mania that has caused problems continuously, whether it's the railroad brakes not being inspected frequently enough, or whether or not it had an impact here. We know it had an impact in the financial crisis. Hey, welcome aboard. Capitalism needs guardrails. If there's any takeaway from all of this, it's capitalism needs guardrails, because unfettered capitalism is how you get slavery and child labor. That's capitalism run amok. You need someone to say, hey, I appreciate your love of cheap or free labor, but we think this is not right. and we're going to put up, just some rules, just a minimum wage, and saying that owning other human beings, not good. We don't want to let you do that.
Getting back to the FDIC, the Roosevelt, and the federal government backing those investments, you also have, what is your very famous libertarian foxhole?
Right. Just quote. As there's no atheists in foxholes, there are no libertarians during a financial crisis, which I think I put in Bailout Nation. I can't remember, but
there are no libertarians during a financial crisis. What do you mean, and what are you seeing in social media over the past few days with libertarians?
So this is, you could go to Ritholtz on Twitter and you'll see all the things, but all the Ayn Rand, let me use a technical term, douchebags, all the people who love Atlas Shrugged and think they're masters of the universe and think, you're poor because, that's who you are and you're not a creator. All these guys who don't believe in regulation and begging for a federal government bailout over the weekend. And it's just, I love it. It's adorbs. I just love that. When somebody's panic reveals their hypocrisy. And, just go look at it. Look at all the people who have spent I don't know what the role of Peter Thiel as an example is, but in this whole event, it kind of looks, and I don't want to say this because, again, there's so much we don't know, kind of looks like, this bank run was started by him. Now, was it legit to say to your investing companies, hey, something's going on here, move your money? Maybe, I don't know. That's why everything I'm saying is these aren't accusations. These are just questions. But the rest of the libertarian crew, and I haven't seen anything about Peter Thiel begging for a bailout. So credit to him for being at least intellectually consistent.
We'll see about that.
It's too late. The bail, that's all money good. So, but the interesting thing is lots and lots of other people who are notorious libertarians, who are notorious. And by the way, libertarians, to be fair, are a spectrum. On one end of the spectrum are the idiots who think there shouldn't be DMV or licenses or, let the free market sort it out. And it's like when Milton Friedman said, we don't need an FDA. So a few kids die from poisoned, formula. The market will punish those people eventually, which, by the way, turned out to be completely wrong. If he was right about that, all the banks that blew up during the financial crisis, according to Friedman, their own self-interest would keep them alive.
Not to mention the oil companies and any other number.
We know about the principal agency problem. It's when you're running a bank, you're running it on behalf of the shareholders. When you're running Lehman Brothers or AIG, you're a management, and good managers run it on behalf of the owners. Bad managers try and figure out how can I extract the most amount of. This is why Jack Welch was the most overrated CEO in America. Who pays himself $1 billion over 20 years and leaves behind a disaster shit show that blows up, accounting fraud, earnings mistake, all this stuff unwinded shortly after he exited. And so, you have all these people who basically seem to be saying one thing in public, but then as soon as the shit hits the fan. But by the way, I'm going to defend myself here. I wrote the book Bailout Nation, and when COVID first started, we saw that the payroll protection policy was, we could get a line of credit from our own bank at 1%. Okay, let's do that. And some asshole said, the author of Bailout Nation got a bailout. And it's like, no, it's a line of credit to the bank, which, by the way, we borrowed to cover our staff, which turns out we didn't need it. And 2 months later, we returned it. So I really try and stay on the right side of you've been consistent
with your words, your actions. Yes.
Right. And by the way, we didn't have to disclose it. We disclosed it publicly because we were naive enough to think we're running a business. At the time, I think we had 30 employees. Now we have about 60 employees.
Well, that's by the way, it's for listeners why we love you and why I always reach out to you, because you're one of the few people in your industry who's not a complete asshole.
Not just a partial.
Oh no, you're an asshole, and no more than I am for sure. But right. That's what I love about you. That's why I like to be in your world.
Can I tell you something?
You're the kind of asshole I like, but you're consistent. You're respectable.
I don't know how to be any other way. First of all, my memory isn't as good as it used to be, so I can't keep track of the lies. So it sort of forces you to be honest. But more importantly. So I wrote
you
something.
were raised right.
There's that for sure. I wrote something a couple of weeks ago, how much money buys happiness. Yeah. And speaking of people who are just so ridiculously honest, Danny Kahneman, one of my favorite Nobel laureates and favorite human beings in the world, wrote a piece in 2010, did a research piece that said, it turns out that money buys happiness up to about $75,000 to $90,000. And beyond that, there's no big impact. And someone else took a giant database and analyzed it and found out that turned out not to be true. So the early criticism of it is, and this is kind of interesting, that's true for people who are happily married. For people who are divorced, it turns out even more money doesn't buy happiness. But in the new research piece that Kahneman did with two other people, which he called an adversarial collaboration, which is the most Danny Kahneman thing, he basically works with them, and they, from this giant database of people, figure out for about 20% of the public, that's 75, let's call it 75 to 100, is where their happiness tops out, and then they flatline. They're unhappy. But for most of the public, it keeps going up to about 500,000, and then it tops out. And so the guy's a Nobel laureate. He's one of the most acclaimed psychology professors. He won the Nobel Prize in economics, which is hilarious because he's not an economist, but he kicked off the entire field of behavioral economics. When he comes out and says, hey, I was wrong here. I overstated it. It's only 20%. How do you not look at a guy like that, a gentleman and a scholar, literally what that phrase was written for, and say, well, if Danny Kahneman said he was wrong and here's the correction, anybody else who doesn't behave that way can't ever be remotely at that tier of humans. And I think we should all endeavor to be thought of as that guy is straightforward, or that woman is straightforward and honest, and I can rely on what they say because, like all humans, they make mistakes. Like all humans, they have biases and self-interests, but at least they try and acknowledge them and not pretend.
Right.
I don't know how else you go about living your life.
Well, I agree with you, and that's why I love talking to you. Final question. I just get this email from Aaron the farmer. He's very mad, as usual. Silicon Valley Bank bailout. Maybe if they pulled themselves up by their boots, they wouldn't need us to bail them out. What a fucking joke. Fuck this country. Did we bail out this bank? Did taxpayers bail out this bank?
No taxpayer dollars involved. This is the FDIC insurance. In your bank account, in your checking and statements, in your monthly fee, there is a couple of pennies that every month go to the FDIC insurance fund, and the banks manage that on behalf. FDIC, just look up the history of FDIC, was designed. So when I was writing Bailout Nation and doing the research of the pre-Federal Reserve era, remember the Fed has only been around for a little more than a century. In the 1800s, in the 19th century, there were bank runs constantly, and they led to all sorts of economic mayhems and volatilities. Forget recessions. We had depressions on a regular basis because you would save diligently, put your money in a bank, and then it would go bust. It was really, again, to go back to what we said originally, banks are the lifeblood of an economy. And if your bank isn't functioning.
To be clear, a few pennies go to FDIC. FDIC goes into effect here for the depositors, people who just deposited their money in the bank. The actual executives I heard were fired. Many of the executives were fired.
They were all fired, right.
And the
Federal
Deposit
shareholders Insurance Corp. That's the name of it. It's an insurance on bank accounts, which the federal government says, hey, listen, you don't have to be an FDIC bank. But if you are an FDIC bank, well, then we're going to charge you for every checking account, every savings account. We'll guarantee them up to $250,000, but we're going to charge you a couple pennies a month.
Just to recap one more time.
It's a social insurance program.
The executives are fired. The shareholders or investors in this bank
wiped out.
Wiped out.
Zero.
But if you invested your money in this bank, up to $250
if you
was insured.
deposited your money in this bank.
If you deposited up to $250,000 was insured, and you
did nothing wrong.
And you would want that if your bank did that. So we shouldn't. Right. We should be not so cynical here because that's not what happened.
This is one of those instances where, at least from the FDIC perspective, the system worked as it's supposed to.
But I don't see this.
Listen, if somebody's house burns down, and they get the insurance pays them to rebuild their house, no one says, oh, that guy was bailed out. He should have lived with the consequences of a fireplace.
No, he had insurance. Right, exactly.
Yeah, right. So you have money in a bank. Now, by the way, if you go to a bank that's not FDIC insured and the bank goes bust and you lose all your money, that's the system. That's too bad.
And finally,
if you're bailed out then that's a bailout.
You have said many times and others as well, this phrase that certain entities, certainly banks in the past, they privatized their losses and socialized their gains.
That's
not the case here.
Right. The losses were held by the investors and managers of the bank, and everybody else was made whole We'll find out what the bondholders get. So in bankruptcy, so what happens with equity owners own a company. When a company goes into bankruptcy, the whole bankruptcy process is we are now going to transfer ownership of this from the equity holders to the creditors, and top of the creditor list are the bondholders, the people who have the highest, by contract, the highest priority and under the law. And so I don't know what the bondholders will get for this. Maybe it's 75 cents on the dollar. Right. Maybe it's 25 cents. We don't know. They'll get something back, or maybe you'll get zero. Who knows? But, you know, part of the thing that made this so interesting is because the FDIC and the Federal Reserve worked together and the Fed said, oh, you have lots of treasuries that are all going to be worth 100 cents on the dollar in 5 or 10 years. Great. We'll take those. We'll pay you early because what do we care? We're the Fed. We have all the money we want. We'll pay you early. And now the bank is fine. The depositors are fine. Crisis averted. Now, what everybody has a little memory of, Josh called it PTSD. I think it's just muscle memory, but you know, they're the same. So last time this happened in 06, 7, 8, 9, it spread, but it spread because everybody was eating the same garbage, subprime securitized paper. It doesn't appear that everybody did this. And that's why one of the first questions I ask here is, why did the bank have so much capital wrapped up in long-dated treasuries? Who was advising them? Bond investing 101 is shorten your duration during a rate hiking cycle. How is this unknown?
That's what you did with your investments.
Yeah, that's what we did. And by the way, in hindsight, it looked like a brilliant move. You still lost a little money. If you go from 7 to 10 years down to, on paper, it's still, you just didn't lose as much. Every bond is sensitive to interest rate duration in a rate hiking cycle, meaning the longer the bond is, the more sensitive it is. So unless you're in a 30-day note that yields next to nothing, you're probably going to underperform. You're probably going to see a decrease in your mark to market, which will recover as you get approach maturity. I mean, all this stuff this isn't complex stuff. This is just basic math. It sounds complex if you're not familiar with it, but trust me when I tell you, the active bond managers all moved out of long-dated securities. They might have even been short them, which is perfectly legit. And they all moved to very, very short term or parked in cash waiting for a better opportunity. That's what active bond managers do. It's kind of weird to see a bank just say, yeah, throw it into the 10-year and throw it into long-dated mortgages. We'll be fine. It seems like either they weren't getting good advice or they weren't getting any advice, because I don't think a lot of banks are loaded to the gills. Maybe they have a little bit as part of a broad arc portfolio that's diversified, but you know, this seems to be, I don't want to speak out of class, meaning I don't want to speak not knowing what I'm talking about. This seems to be kind of unusual to have so much money tied up in so much long-dated bonds during a rate hike.
We'll see the answers to all of your questions, all of which people can find at your latest post at Ritholtz.com. But would you be comfortable crafting some kind of a short tweet that says SVB did not get a bank bailout? In fact, FDIC did its job. Thank you.
I basically implied as much in the blog post. I think that's obvious. The people. So let me phrase this in the most obnoxious Ritholtzian fashion I can. If you think this is a bailout, if you go out and tweet, "Oh, these guys were bailed out," all you're doing is revealing how clueless you are about banks, about regulation, about the FDIC, and just pour yourself a tall glass of shut the fuck up. And let people who know what they're talk about it. Or even better, do what I did today and say, there's a shit ton of stuff I don't know, but hopefully we'll find out over the next couple of years. And maybe I shouldn't go on TV and go blah, blah, blah when I don't know what the hell I'm talking about. Although that advice is something I've said to people over and over again. And, often the media ignores it because, hey, they got 24 hours a day.
Well, you got to say something and fill it with stuff that makes people.
My favorite, I've said this to you before, but I was offered a daily TV show, and my answer was, I'll come out each night and say, own a broadly diversified portfolio of low-cost indexes. It could be global in nature. Rebalance once a year. See you tomorrow. And then you have 59 minutes and 47 seconds of dead air. That doesn't go anywhere. So that's why the weekly podcast is, hey, who are you, wildly successful, brilliant person, and how did you get that way? And what can the rest of us idiots learn from you? That's what I think is the whole genius of the podcast. To me, that's more valuable,
of course,
than me talking, giving you a hot take on what just happened.
Which is why I've been having these long form conversations with you for years. Go subscribe to Masters in Business. That's Barry's amazing podcast. I'll have to go listen finally to that Ray Dalio interview. Thank you very much.
Man. Always fun to see you. It's always a blast.
Bye-bye.
All right, there he goes, Ritholtz. Always fun to see you, always a blast. I agree, and I hope that answers most of your questions about this, at least that we know the answers to, and I hope that you'll let Ritholtz know that you heard him here on the show. Tomorrow I'll be talking more economics, at least economic inequality, wealth inequality, wage issues, and just general ridiculousness about our culture and capitalism in America with the great author Alyssa Court, who is a former collaborator and disciple of Barbara Ehrenreich. She's got a new book out called Bootstrapped, so don't miss that tomorrow. Also, I'm set to talk to the great Bill Boyle about all things Russia. Over 1,000 dead Russians in the last 24 hours. I just can't believe it. 200,000 dead Russian in the year of war. I mean, the numbers are just outrageous, astronomical. I can't believe that many guys died, and they're continuing to wage this war. We didn't lose anywhere remotely close to those numbers in Iraq and Afghanistan combined. It was under 10,000. And I mean, that was years and years and years, to over 20 years. In 1 year, 200,000. And yet they continue to wage this war. So much unnecessary death in this war. And I'm not even talking about the innocents in Ukraine. So that is tomorrow. Hopefully I will make sure that we get to talk to Bill before I think he's going to Ireland. St. Patty's Day this week, as well as show number 800. How about it? 2 more days. I think that's on, Wednesday, Thursday? Show number 800. Should we do something? Let me know if you have any ideas, bumblebees. That's the people who listen all the way to the end. You know who you are. You are the best. I love you guys. Thank you very much for tuning in. And I will talk to you right here tomorrow on Stand Up with Pete Dominick Daily. Jon Carroll, take us away.
Red and brown, she's the place where every lost child will finally be found. There's only one thing to do before we stand our ground, and that's stand up, stand up. Well, the founding fathers saw a land for all. They had to stand up, they had to stand up. They had a keen imagination for a crystal ball, drawing all the plans of stand up. But all they had to go on was the time they were in. With other causes for laws, and since they weren't in sin, they knew that change was gonna come before the change could begin. They had to stand up. All right, they had to stand up. We got to stand up. We got to look the devil square in the eye. We gotta let him know it's his time to go, to make it clear when all we hear is a lie. Why you lying awake wondering where the money all went? Cost of freedom that'll go unspent. You can see him flee the scene of that experiment if you stand up. Alright, we got to speak up, we got to reach up and raise your voice in every way you know how. Don't be toes up, you got to show up. Ain't no better time to do it but now. No need to pledge allegiance to no wanton tribe. Rise up, show obedience to the voice inside, and listen well and it'll tell you not to run and hide. It says stand up, stand up. Oh, got to stand